Today we look at why property investors are fleeing the market. Hello again, I'm Martin North, the Principal Analyst at Digital Finance Analytics. Today, we continue our analysis of the latest results from our household surveys by drilling down into the segment-specific data, having in our previous post looked at the changing dynamics across our household segments. And we start with property investors, who are becoming significantly less active thanks to a tightening of lending standards, higher mortgage rates, and more limited capital growth. As a reminder, the latest available ABS data shows that lending flows to investors is slowing, and especially to interest-only loans. And yesterday we showed how their buying intentions were tanking, and the number with interest-only loans who are now being forced to move to a more expensive principal and interest loan is rising. So now let's look at the data in more detail. Let's start by looking at solo investors, those with just one or two properties, and their motivations. The predominant reason for investors to hold property now relates to the tax benefits which can be accessed at 46%, up 3% from December 2017. This includes the ability to offset costs, including interest costs against tax, as well as access to the very beneficial capital gains. The other driver is the perceived better returns compared with bank deposits at 39%, despite the fact that if you tot up all the various costs of an investment property, including returns from rentals, half the properties are now underwater. Other factors, such as access to low finance rates at 1.9% and appreciating property values at 4.7%, are becoming less significant. The pattern for portfolio investors is very similar, so looking across all investors, we see a similar footprint, with the drive to gain capital efficiency 45% up 2.4%, better returns than deposits 23%, and low finance rates down to 6.1%. Appreciating property values account for 18% of the motivation, down 2% from the previous quarter. Now let's turn to the investor barriers, and we see a significant rise in the number of investors who are unable to get finance, up 3% to 36.7%, a trend which started in 2015 but is now accelerating. A further 10% see potential interest rate rises as a barrier, up more than 1% from December 2017. We note that RBA warnings have now only a very small impact at 2.5%, down 2% from our last surveys. Now let's look across to property investment via a self-managed superannuation fund. And once again, tax benefits at 45%, up 2%, and better returns than deposits at 14%, plus leverage at 17%, account for the majority of the motivations to transact. 14.6% of self-managed super fund property investors are still expecting further property gains, but this is down by more than 2% from the last survey. Low interest rates on mortgages accounted for only 2% of the motivations. We also examine where trustees of self-managed super funds obtained property investment advice. 24% obtained advice online from internet forums, 21% use their own knowledge, 15% use a real estate agent, 15% also use an accountant, and 11% use a mortgage broker, and we note a 2% drop in those using a mortgage broker compared with our December data. Finally, the asset allocation of a self-managed super fund into property varies, with 30% holding somewhere between 20 and 30% of their funds in property, 29% holding 30 to 40%, and more than 11% holding more than half of their assets in property. Only a very small proportion hold, though, more than 80% of their funds in property. And interestingly, the mix has not really varied significantly over time, but the proportion of all super funds with property assets has risen from just over 3% to more than 5% and continues to rise. Such non-recourse borrowing has been identified by APRA as higher risk. So in their new guidelines, banks will need to hold higher capital against these loans. And in addition, of course, David Murray's Financial System Inquiry, do you remember that? The FSI, recommended that self-managed super funds should not be able to leverage into property. And we support that recommendation, which, by the way, the government rejected. So, standing back, it's clear that investors are getting skittish, hence the low demand for property, as well as difficulty in gaining access to finance. This is why we think investment property demand will continue to fall. Finally, the number of first-time buyer investors, those who were going direct to the investment sector, continues to fall, as can be seen from our analysis of ABS and DFA datasets. Next time, we'll take a look at first-time buyers. If you found this useful, please do like the post and add a comment or question. I read them all. If you've already subscribed, thank you. I really appreciate your support. And if you've not yet subscribed, please do so to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.